Professor George, and thank you for inviting me. Um, uh, I started my career when I was working in Bell Canada. I was a Bell telephone technician, and I started my fund in 1991 when I was still there. I was introduced to value investing by reading a book on Benjamin Graham in 1979. And what I found, and this is what I would like to share with you, is my experience being a portfolio manager, and especially in the realm of value investing. When I started like in a more simple way of evaluating companies, and they were net working capital. And at that time in 1981, there were plenty of net nets. And I found that if you buy it at 2/3 of net nets, they worked out wonderfully well. But there are restrictions to net nets. They tend to disappear fairly quickly. And so there's just a moment of time, maybe 6 months, where you can exploit that. And so from then on, I went to, let's say, discounted book value. And they also worked out well, provided you buy them really cheap. And slowly, as my business knowledge increased, I went into better quality companies, like buying companies on earning power, like buying companies that are low price to earnings ratio, low price to free cash flow, and so on. And that worked out well as long as you bought good, solid companies and you're buying them, let's say, below 10 times earnings. And when you say good, solid companies, that means the financial leverage was not high, management was quite capable, and in an industry where where revenues were not going to decline in the future. Then over the years, I went into other type of investing, let's say junk bond investing, buying non-investment grade bonds, and they worked out really well too. And provided you buy them at a discount. So the key in all this is whether see, our temperaments are different. Some of us, even if all of us go into, let's say, value investing, some of us would like to buy better quality companies. Some of us would go towards, let's say, net nets, like Peter Kendall did. And some of us may get involved in distress investing. Distress means they're worse than junk bonds, where company has to be recapitalized and so on. But in all these different ways of investing in the value spectrum, the valuation has to be accurate. If they are accurate, they work out quite well. Now, sometimes we talk about like value traps, we fall into value traps. But when we fall into value traps, that means that's an error. We made an error in judgment. That's why we call them value traps. It's not an excuse. If you're accurate in your valuation, you will do well. So with that kind of a basic introduction, I'll just leave it open to question and answers.
Cool. So, yeah, one question that I would have is, you say you have to be correct on the valuation.
Yes.
I guess this is where the margin of safety comes in as well.
That's right.
That you might make some mistakes here
Yes.
and there, but if you take an equal margin of safety, it will protect you
yes.
from some of the mistakes. So, would you like to speak up on what's your use of margin of safety in your valuations?
Yeah, yours is an excellent question. And so when you're looking for margin of safety, it has to be significant. And when you say when your valuation, when you talk about valuation, it doesn't have to be really exact. It can be a valuation, let's say a company is worth somewhere between 80 to 120. And I'm buying it less than, let's say, $60 less. That gives me more than adequate margin of safety. And you will find in this step of investing that we are in, the value principle is so profound. It allows you to make mistakes and still have excellent results. Now, according to John Temple, and even based on my experience, as long as you're accurate, roughly around 60%, your batting ratio is around 60%, you will do quite well. Now, think about certain odds when you play about it. Another way to look upon is odds. So, if you go to Las Vegas and you have all these gambling companies, let's say MGM and and you go there and you gamble, the edge to the house is only 53%, 53.47, and yet they make tons of money, provided you do it millions and millions of times. So here, you need to be accurate around 60%, provided you don't blow up, and you will do quite well. So your margin of safety, again, doesn't have to be like super accurate. It has to be a range, somewhere between, let's say, between 80 to 120, and you're buying it around $60. And if you do it over and over again, it will work out quite well.
So with regards to value investing, you said you moved into distressed debt and other type of assets. Is that Was there a specific reason for that? Was that because you didn't find enough value in the equity sort of market space, or do you just want to expand and go into a different asset class altogether?
See, that's a really good question. See, what happens is when you are a portfolio manager and you're managing a fund, the market is not obliging. Like my strength, let's say, I prefer good quality companies. By and large, I prefer to go with good quality companies, good management, low financial leverage. But the market is not accommodating. There are periods where nets are cheap. There are periods where discounted book value is cheap. There are periods where junk bonds are cheap. So if you look at in the period, let's say 2002, junk bonds were really cheap. A lot of debt you were buying around, let's say 30 to 40 cents on a dollar. In 2008, 2007, 2008, and 2009, there were debts, like bank debt, that were rated A, paper, let's say, like Wells Fargo, Goldman Sachs, and Bank of America, they were selling around 40 cents on a dollar. And at that time, I was also running a bond fund, and I was able to buy all these bonds at 40 cents on a dollar. So when you think about that, prices in bonds, you're not talking about just junk bonds selling at 40 cents on a dollar. There will be periods where, based on my experience, where I was finding A-rated paper, let's say on Wells Fargo and Interpublic Group, Goldman Sachs selling at 40 to 50 cents on a dollar. So the market, so the key thing is be ready, and if your circle of competence is wider, it gives you greater opportunities, so you're not stuck.
Why is the market so wrong? I mean, we're talking about a company not in distress, and yet the market's like 40 cents to the dollar. Why can it be so wrong? I mean, why?
In 2008, there was a big financial panic, and so in 2008, most of the companies, most of the debt in financial companies were really cheap. In 2002, a lot of telecom companies were cheap. So we are buying, for example, let's say WorldCom it went down to as low as 10 cents on the dollar. And then I remember buying Nortel around 13 cents on the dollar. So it went into bankruptcy. And when it recapitalized, we got 100 cents on a dollar. So it depends on the time. And at that time, a certain industry would be in big turmoil, and you can buy them.
So do you value liquidation value of the assets, and you say, well, they've got the assets that they sell, they must be going to make more than what I'm buying?
Yes. So that's a really good question. So you can see we are talking about equities more or less. This class is about equities. But that same kind of methodology, same kind of thinking also applies to debt. So when I'm buying, let's say, something at 40 cents on a dollar, and I know even if this company is going into bankruptcy, when it comes out of bankruptcy, it would be worth around 80 to 100 cents on a dollar. Bond investing is sometimes easier because you're way senior, and depending on the capital structure, is senior to equities. So it's sometimes so cheap. A lot of times when you're buying equities, if you buy it at 75% of revenues or 50% of revenues, you think it's so cheap. But when you're buying some of these bonds, distressed bonds, at that particular time, you're buying them at 10 cents on a dollar. On top of it, it's so senior to the structure. So if sometimes you wonder why we don't go more into junk bonds.
I have two questions. The first one is related to bonds. When you looked at some of the distressed bonds that you mentioned, and the auto industry was going in the tank,
right?
What was the fundamental differences between, say, buying Nortel as a pension obligations with because the bond owners all fried in the car business. So how did you stay out of General Motors bonds or Chrysler bonds, but still go into a Nortel bond? What was the deciding fundamental factor?
You have a really good question. When you go into car manufacturing, especially the North American one, they had huge pension liabilities. That I didn't know how it's going to get resolved. And in some of these cases, the pension liabilities come senior to the bonds you're buying. So when you look at Nortel, for example, you look at the patent value, the value of the company, and and the pension liabilities were not as huge as let's say compared to car manufacturers, especially the North American car manufacturers. So in the end, it comes to certainty. Certainty of certain numbers. As you go, you itemize them all these items, and certainty that you have, and the greater certainty you have, the more sure you are of your investment. So that's also another key area. Don't go into areas that are more gray. where you need to have more judgment.
But Nortel had also pension liability.
It has some, but the value of the company was so much more greater that it overcame whatever pension it had.
And the last part of my question was the biggest fundamental mistakes you see value investors, contemporaries of your own that you meet, and not just successful ones, but more particular to the ones who blow up or make mistakes. What are their biggest errors, and what is your right versus wrong rate?
A lot of areas, if you do make mistakes, would be like being overconfident, over-concentrating. And you have to be careful, but there's a book, you have a good question in terms of allocation of capital, like the weighting you should put on it. And there's a book called the Kelly Criterion, K-E-L-L, I think Y, Kelly Criterion, and it talks about, depending on, how strong you feel about a company and the certainty of odds, how much you should put in a company. But there is a danger. When you over-concentrate, the chance of blow up is pretty high. And then when you talk about concentration and how much you should put into it, you should be very careful in terms of the way we talk. Like based on my experience with some people, they say I have a 95% confidence. But that is his confidence in that company. But if you give it to Buffett, Buffett has more, let's say, more knowledge, has been for 80 years. In his eyes, would be only 20% confidence. So you have to be very careful when you talk about confidence factor. Your confidence factor is only based on the knowledge that you have at this time. So that's where mistakes will come in when you're overconfident, and also going into areas where that certainty, the percentage of being right. You go into areas where it's very hard to predict. Yeah.
How do you go about learning about different industries? So how do you do that?
So, that's a good question. So when I was young, let's say 25 years, so I was doing things simultaneously. So these are the things I was doing, and I found it really helpful over the years. So first you find all the bargains, since I was running a fund. Secondly, you should always devote 6 months to one industry and start and try to read as much as possible on that industry, even going back like 50 years, 100 years. So spend 6 months just to understand an industry. Also, if you're in this, let's say in this investing, don't just look at stocks. Don't just look at stocks just because they're cheap at this time. Just have a kind of a library in your own head of, let's say, 500 to 1,000 companies. How well they're doing, and what the return on equities are for certain companies. But just don't look for bargains.
And the second part of my question is, how did you learn to apply value investing? Because you said you just read a book, and then how did you end up, actually learning how to apply it?
At that time, if I start right now, it would be really tough on me because of the situation I was in. I was in Bell Canada, I was not educated at grade 12. But I was really lucky that in that period, that when I started value investing and I started my career, these nets were really cheap. So the rest of the mathematical formula, there's 400 companies. And a lot of times when you buy net companies, like they are trouble companies.
Can you explain what net is?
So net would be you take your working capital, right? Current assets minus current liabilities. You minus out all the liabilities, preferred shares, long-term debt, right? Whatever number you come at, you buy it around 60%. So it's just a mathematical formula. Current assets minus all liabilities, including preferred, and stock selling below that. So in other words, you look at it, you're liquidating the company, and if you get 100 cents, you're buying at 60 cents. So it's almost a foolproof way of doing really well. And a lot of guys have done well based on that formula. So it requires not much thinking. Peter Connell has done so well, Walter Schloss did really well, Benjamin Graham did really well. And it worked, as long as you can find a basket of it. Yes.
Francis, a lot of people stay away from financial companies, partly because of the leverage and various other things. But I've seen in a lot of your funds, you buy Goldman Sachs bonds and things like that. When you analyze financial companies, as opposed to for example, the net, right? And net in a manufacturing company, you can sit right down and come up with a pretty accurate figure. You can't do that for financial companies. So can you talk about how you think about that whole process?
Financial companies, and that's a good question, and sometimes you can fall into a big trap with financial companies in the sense of the period. But if you look at the letters I wrote to my shareholders in 2006, 2007, I warned them about all the dangers in financial companies, especially US banks. They have all kinds of derivatives, all kinds of fancy accounting, and you couldn't account for it. But things have changed now since the meltdown. They have cleaned it up. They have cleaned up their balance sheet. You have all kinds of regulators looking to the books. So it's much cleaner now. So when we talk about a black box in 2007, it was more a black box of all negative things. Now we still have some negative stuff, but now the black box has gone positive. Plus, as you know, interest rates are zero. So banks are paying nothing for deposits. So they have a tailwind. In some ways, we consumers, consumers, and we don't complain, and we are taking the hit, and you're not getting any returns on any of the savings. So the Feds have allowed the banks to earn their way out of whatever trouble that they have. So it depends on on the period that we are in. But it's a good question. Banks are really you have to be really careful, especially in areas where they do a lot of derivatives, a lot of income is generated through trading. It's much safer to go into the vanilla type, the deposits, and then lend out money to companies.
So did they learn from the mistakes, or are they gonna repeat them again?
Most probably human behavior for what they are, they're going to repeat sometime in the future. Yes.
I was just interested when you were investing in net, what sort of environment there was at that time to create the net opportunity.
Yeah, so 81 there was, so I would buy like say 10 to 15 stocks, but nets in the sense that you have to be careful, you cannot buy one or two, so you're basically playing a basket. Nets more or less, some of them are trouble companies, so two of them may not work out well, two of them will work out spectacularly well, and the rest will do kind of quite well. So overall the basket will do quite well.
Was it because we were in a recession or coming out of a recession?
Yeah.
What sort of created?
Oh, you mean the scenario? Okay, at that time, you're talking about going back to 1963 to 1981. For that 18 odd years, 20 years, the Dow went nowhere.
Yeah.
It was around 663. So 1981 was also around 600, but the book value was at 1,000. So almost every company was cheap. So even good quality companies were selling at 6 times, 7 times earnings. Interest rates were around 15%. So everything was estimated. So in that period, you could have bought any type of stocks and would have worked out well. But because I was just starting fresh, starting new, the nets were my security blanket, and they did that quite well. Yes.
Sorry, just a follow-up on the question on the financials. Can you elaborate a little bit about your theory behind those TARPS warrants? For example, Bank of America, it went up quite a bit, and I think you described in your letter that you sold and you're looking to get back in. And so just a little bit of a more...
Oh, okay. You mean the mistake I made selling it out and
no,
the confession I made?
I think I'm more interested in how you really got in. Talking about these banks are selling the old books, but the books are still very opaque and several companies. I'm just wondering how you really kind of look into it, and if there is another price you're looking at in terms of those Bank of America TARPS warrants, and you're looking to get back in.
But yeah, that's a good question. So you look at these banks, let's say Wells Fargo, and some of these banks, and so you're looking at earnings, before provisions and before taxes. They were around $30 to $40 billion a year. They have a lot of negative news, a lot of some legal problems and all that stuff, but they were like $10 billion or so on, even if it comes to us. So when we read the newspaper, we sometimes think only like in isolation, a $10 billion claim or $15 claim, but the earning power is so huge that it would totally pay off. Even if it comes to worse, they would pay it off. But second was the price. These like Bank of America, the common was trading around, let's say $6, $7, but the book value is $20. The tangible book value is around $13. So when you buy it at 6, it's really cheap. So you could have gone either way. You could have bought the common, or if you want to play the warrants, you could have played the warrants. Now these normally when you buy long-term warrants, you have to be careful in the sense because there's a time element involved. But this time element was so long. Most of these bonds, most of these warrants, the date is like 2019 when they mature. So it's a long term. So you allow the earning part of the company to grow, and eventually, the warrants will also do well. So when you buy warrants, if you buy long term, it's investing. But if you buy a warrant for only that matures in 6 months or 1 year, that's speculating. Then you're speculating. So here you're buying a company that potentially could earn $2 to the $3. Books are fairly clean because they're just coming out of 2008. Yeah, book value is $20. Tangible book is let's say 13. Has huge earning power, somewhere $30 to $40 billion. So all these are factors behind you. And then rates are so low. Rates are so low. So banks don't have to pay that much to get your free deposits. So all these are tailwinds. So when you think about it, so in the end, it's always valuation. How cheap are you getting?
Over there.
Yeah.
I just wanted to understand, basically 2 questions I had. One is, how do you exactly zone out from the noise in the market? Is there something that you do to keep yourself aware of the biases that you may have when you pick a stock? And is there something you do on a maintenance basis and when you incorporate it into your research?
Eliminating noise is really critical because investing, the mathematical part of investing is very easy. Let's say you can take the discount rate, you can see the history, but the psychological part, the mental part is the more difficult part. If you can master that to some degree, you will be a great investor. So you have to, when you're in the market, it's your judgment, like your valuation versus the world. It's you on your own. So don't get influenced by outside forces. They will just corrupt you.
Is there something that you have done and you would advise people who are kind of getting into this money management business to do?
Yes, if you're in the money management business, you have to think independently. It's your call, it's your judgment versus other people. And if you let other people influence you, right? Other people, if you read about it and you cannot eliminate the noise, then you become the patsy. That's the way you look at it. Yeah. To have control, you make the judgment. Then the market is a patsy. The market is giving us stupid prices for me to exploit.
Just one more practical question. How do you prioritize your reading?
I roughly read, when I was young, so it's different versus now. So when I was young, I had to know companies, let's say 500 to 1,000 companies, and I roughly read around 200 pages a day. Just kind of general knowledge. Know what's happening in the world. Yeah, well, maybe.
Do you have any view on the current market landscape in terms of areas you think might be undervalued?
I don't find anything cheap. So just to give you an idea, I can go with junk bonds first. So at this time, if I come to the market right now, I'm a company and I'm kind of a let's say fundamentals. My company has some trouble and it's rated, let's say, non-investment grade. I can come to the market right now with a 6% coupon, for 10 years, right? And I could sell it at 100 cents on a dollar. Investors are buying for less than 6%. That 6%, if you go back, let's say just 5 years ago, this very coupon would now be trading at 35 cents. You can see how the junk bond market is not cheap. No. And say an equity market is cheap only if you think interest rate will stay at this 2% for the next 20 years. Otherwise, the valuation is not cheap. Yes.
You focus a lot on the being cheap and buying. Would you like to speak about your exit strategy? I know a lot of value investors sell early. So would you like to say some of the lessons you got in terms of your exit strategy and when you're adamant that you need to go? How do you approach selling, basically?
Selling is sometimes a little bit more difficult, but I've looked upon investment more like a 50-year marathon. So normally when it approaches closer to intrinsic value, I get out.
As soon as it approaches?
Yes, as it's approaching, I try to get out.
But usually, don't you find that the case is that the market kind of goes a bit further than the intrinsic value because of the hype, you know?
Yeah. There's a tendency in the stock market, that it will overshoot. But the key thing in investing, at least for me, the way it has worked out for me is that I have done well because of the principle I follow. But if I let it overshoot and I get into this habit of not selling when it's closer to intrinsic value, then my principle, that I believe it, I'm eroding that principle. Eventually it will land me into trouble. So that's the reason why I try, and stick to the principle. It's the principle that is pulling me through.
Are there other reasons besides reaching intrinsic value that you may sell?
But sometimes you're not comfortable with management, the capital structure, the capital expenditures, where you're spending money and so on, and then I may get out. Especially if you're buying another company that's let's say expensive, and you'll find that frequently. Let's say like this company itself is cheap. Let's say it's 80 cents on a dollar, but they're trying to buy another company at 140 cents on a dollar, and then you want to get out because when the company goes on acquisition spree, there's a tendency that the present shareholders, their value is being eroded.
Can you possibly give us an example of a mistake that you made, I guess, in picking a security, a stock that you sort of, bought and didn't work out as you expected, and how did you sort of exit that particular investment?
I have made several mistakes, and some of them are kind of boneheaded, and sometimes I just admit it, because if I don't admit it, then I tend to repeat it. So I just say, I made a mistake in my letters. And there was one last year that most probably I was sensing that could be a potential fraud. It's a company that does a lot of business in China, and I went into it and I lost most probably all the money. But there were dangers, I could sense it, but the stock was so cheap and I got sucked into it in the sense that at one time they offered, let's say $6, they were selling at $2, and the shareholders didn't accept it. But then you could see the management was doing stuff that is funny. And most probably in that case, I should just have got out of the stock. Yes.
The right and the wrong thing. So do you track how many times you're right versus wrong in your portfolio? And secondly, do you have errors of omission? And do you sort of look at them and track them versus the correct omissions? So your right-wrong percentage. Can you just give us a flavor for how a successful value investor like yourself, how many times you're right versus wrong, hypothetically and actually?
Yeah, it's a good question, and all of you must do this exercise when you get into this field. And so, let's say I started my fund in 1981, and I had bought a lot of stocks, let's say for the next 5 to 10 years. And then I would track back, all my successes and failures. And the reason for tracking it is to know your strike ratio, like how accurate you are. Because if you don't know how accurate you are, then you cannot concentrate. I am by nature a concentrator rather than buying a whole basket. By nature, I'm a concentrator. Now, there's no advantages being a concentrator versus buying the basket of gold. But it is up to you. But if you're a concentrator, you should know your batting ratio. Therefore, you know how much you can concentrate up to. So over the years, since I tend to go for good companies, you will see the errors of omission is far more, it hits you more in terms of future returns. It's far more than a mistake that you make. If you make a mistake, you can always make up, with other stocks. If you're a good enough investor, you'll always find some winners. But omission is always a problem with good companies. They tend to grow, its intrinsic value tend to grow. Like in that example, it was like say Stella Jones, right? It has grown, let's say 24% a year. But you have to be careful with that kind of number, 24%. So in your own head, this is not a critique, but just as a, just saying it out loud. At 24%, revenues is doubling every 3 years. In 9 years, it has gone up 8 times. So when you're in that kind of a situation, you have to think back. Revenues is 1 billion. In 9 years, could it be 8 billion, and would it overtake the industry? So those are the way you work backwards on it. But just don't take your percentage, let's say 24%, but work it out in terms of the numbers. So 8 times, so in 12 years would be 16 times the revenue. So would it be 16 billion versus the billion right now? So that's how you work it out. So omission is always a problem with good companies. But if you're going with mediocre companies, then you have to be careful not to make too many mistakes in that basket. So so you need a batting ratio of roughly 60% to do well. And more or less, Buffett is, in terms of his batting ratio, is closer to 95%. For most of us, most probably around 75, 80.
Do you see any value in meeting managements before you take a concentrated position?
Meeting management, at least on my experience, only makes sense once you know the company well enough. Management, when you talk to management, and anyone who has gone up to a level of vice president, and especially a CEO, is a good marketing person, is a good salesman. They can lead you anywhere. So know the company first, and then talk to management. That's what I found.
How do you put a value on patents?
Patents?
Yeah, like say Nortel or BlackBerry. How do you go about valuing those?
Sometimes you do it like what they sold for. You can see, patents are always sold between companies, and then you try to evaluate. And you don't do it on one patent. You do it, let's say, if they sold 10,000 of these, how much would be worth? So you get some of these numbers. So it's more or less, guesswork, but you need to know some idea of what the guesswork would be. What your guess should be. At least be somewhere around, in that park. Yeah. Oh, okay, maybe I will take you.
Well, I got two questions. One follow-on is a question on the meeting with management. Like, other than reading all those public filings and annual reports, do you have any other major channels that you get all this information from?
See, one of the major issues you have with management, and one of the responsibilities that they have that is so critical to increasing your intrinsic value is allocation of capital. And because they are coming in different different fields, that area is their weakest. So you should go back, let's say, 10 years and see how well they have done in terms of allocation of capital. That should be their number one skill, but they are always lacking in that. So if you look at a few companies, let's say Fairfax that you all may know, or Warren Buffett, it has nothing special. The only special that Buffett brings to the table is how he allocates capital. And investment, value investing, is a form of allocating capital. That's what we are doing. So understand how they allocate capital. If they're good enough, then you can stay with them long, let's say, for a very long time. In 1981, when I first came into the business, Berkshire Hathaway was selling for just $300. Today it's $170,000, and it's made based on allocated capital. Same thing with Fairfax. Fairfax it started in 1985, and we went into it at $3. And today it's at $400. And yet the story is not on some brilliant business strategy and all that. It's just allocated capital.
So you have mentioned the Fairfax, right?
Yes.
We noticed that Fairfax invested heavily in REIT, BlackBerry.
Right.
So based on what we learned in this class, like usually we invest in companies has a long history, stable, we can make a call on the interest value pretty sure. So on companies like REIT or BlackBerry, these kind of companies that's in a transition period, what's your view on valuation of this kind of
I think at the time Fairfax went into it, and Fairfax had a splendid record in spite of making a lot of mistakes, not only with BlackBerry, but at the price that they went in at, let's say, $40 a share, it was based on operation, how well they're going to do. But at $30 is more, let's say, what the assets would be worth. So whatever they can do positively in the future, the prices will improve. But at this time, if you buy at these prices, more or less, it's safeguarded by patents and other assets that they have. So they have few strengths. They're number one in Indonesia and so on. But based on operating earnings or what it could earn in, let's say, what it was earning 2-3 years ago, that's no longer a fact. You cannot depend on that. The market has changed and so on. Yep.
On averaging your costs down, you're confident of the valuation. An example is Overstock. You keep buying as the stock comes down, the stock price comes down. Do you have a limit in terms, I don't know, book value, for example, or any way that you will control yourself in concentrating too much? Because on the market cap position, it won't show up as a big number. But as you buy more, as it comes down, how do you control the risk?
Well, you seem to have studied my portfolio. So, Overstock is a good story.
Yeah.
And let me just give you a few background to it. And that's why you compare, you have to know your industry and you have to compare, other companies. So we look at, Zappos, somewhat similar to Overstock. And Zappos, 2 years ago, sold its business to Amazon for 1x revenue. They roughly started at the same time, 1999. Roughly at the same revenues, like $1 billion. They sold to Amazon for 1x revenue. Overstock has also $1 billion in revenues. But if you net out the cash, right, it was selling at $100 million at $7, at 10% of revenues. And it was not losing money, it was generating cash. And it was not, so how can you go wrong at $7 at $100 million? So it can be, so you can say to yourself, it won't be sold for 1x revenue. But what about half times revenue? Let's say 500 million versus 100 million. So I just bought more and more, although I was, pilloried in the newspapers, in the press. But that's where conviction comes in, right? And then the business model is different. Like Overstock has kind of a business model where most of their earnings were generated, through a business. Let's say if you want to sell pillows and you don't have a website, you're not famous. You go and go to Overstock and said, can I put it on your website? And I want to sell all these pillows. So and you sell it, let's say, for $1,000. What Overstock does it, you sell it, they keep that $1,000 for 30 days, right? And they keep 150, they keep 15%. 80% of the business was like that. It's called the fulfillment business. Amazon has 30% of the business like that.
Yeah, I understand.
So that's why conviction comes in, knowledge comes in, and the company did not have any debt, had a lot of cash, selling at 10% of revenues. And I know that if someone were to buy this company, they would sell for somewhere around 500 million. So I just kept buying.
So
and one time was 30% of the portfolio.
If your conviction is strong, you won't limit yourself.
No, if my conviction strong, then I also have to understand my error rate in terms of judgment on these type of situations. And so, yeah, definitely.
Sort of wondering, what role did sort of mentorship play in your career? Like when you just started out, did you have anyone to sort of look to help you out and to sort of guide you in terms of your own principles, or did you just sort of come up with that yourself?
No, that's a very good question. And mentorship doesn't have to be direct. You don't have to be talking to people. And a lot of mentorship can go back like hundreds of years ago. So basically, when you're buying a stock, when I was young, just starting out, you basically would say, I've read a lot about Buffett. I've read a lot about John Templeton, a lot of other famous investors like Benjamin Graham and so on. And I would ask myself, what would Buffett think on this stock? So indirect reference. What would John Templeton do in this situation? And what would Benjamin Graham do in this situation? So you always look at some kind of indirect mentorship. It's the same thing in politics. Sometimes when you're thinking, what George Washington would do, and so on and so forth. And so indirectly it worked for me. So as you know, I was working in Bell Canada and I was never worked for an institution, but I always used that source, indirect source, to help me in my judgment call. So a lot of times it avoided a lot of trouble. I looked at something really cheap, but it has too much debt, and I would say, because it has too much debt, Benjamin Graham would reject it, Buffett would reject it, so I would reject it too, in spite of, at that time how enticing that stock may be.
None of us just tend to stay away from tech and animation stuff. You made an investment in Rainmaker Entertainment. What could you talk about your justification for buying a stock like that?
Well, the Rainmaker is going through a business model. It's kind of different. I have had this stock for a long time. Most probably I bought that around 20 cents or something and went up to around $3. Has good people there. But right now, they ran into a lot of difficulties. China can make all these, in that business, they can make it at half the cost. So competition is still huge. So it has stayed in the portfolio because it's so small. I cannot liquidate it, but it doesn't have any impact on it. Although I do own a lot of that company. So you can see, economics changes, and you have to be careful.
I have two very, very practical questions. Number one is for someone who wants to start out to be a fund manager, manage other people's money, what would you recommend in terms of legal structure? Whether it's this partnership, same as Warren Buffett started, or same as what you did, start a fund, or just be an advisor, or what's your advice, number one? And number two, any advice in terms of philosophy, those kind of things you can get into the person?
No, it depends how strongly you feel. If you strongly, like in your bones, you feel you want to be a portfolio manager, pursue that field. And I can also tell you one thing based on my experience. You don't need to work for an institution to be successful. But you have to be good yourself, and you can do it yourself. You don't need an institution. No. Once you come to a certain standard, people will recognize you in time. But you have to be patient. It doesn't happen in 2 years or 1 year. But make sure every day you hone that skill, hone your judgment, and make sure you're well read, and things will open up. But if you feel strong enough to be a portfolio manager, and that's your goal, you can achieve it. And when I was young, that was the biggest problem I was facing. I came from India, I'm an immigrant, and there was always kind of a thing, can you break through? And I felt inside of me that if I'm good enough, I can break through, regardless of whether I'm educated or not. Let's say in terms of a degree. So that's a key thing. Make sure you're good enough, and things will happen.
So what process, like what step one can follow to start managing money? Like what would you say is the right way to do this?
Yep. So inside of you, see, are you strong enough in terms of buying a bargain? Buying bargains, it's a boatload of them, and have a success ratio of more than 60%. Like how strong are you?
But you recommend that somebody start working as an analyst somewhere to get experience, and then go and do on his own, or how do you?
My feeling is that you can do it on your own, because a lot of times what happens is, that your career should not be predicated on someone else. It's all inside of you. That's the way I felt it when I was young. Because institutions may not give you, may not hire you. And sometimes if they do hire you, let's say in a brokerage house, you have to do that bidding. You have to, analyze things in a certain way that compromises your principle. So when I was young, I was avoided all that. I just wanted to go pure value investing. And I avoided institutions where it would corrupt me. They corrupt me in the sense that I have to make an earning, but I could only make that earning if I, go the way that institution wants me to go. But I wanted to go the pure way and be long-term successful over 40, 50 years. Not for that period where I have to earn a living. And so I would say if you can get a job and work for a value institution, that's a big plus. But that is not necessary. You don't need to work to be successful as an investor. Later, let's say after 30, 40 years as a career.
How do people trust you? How do people trust you?
Oh, it's what you do is you always have a circle of friends, a circle of people, circle of people that you work with. And that's what I did when I was in Bell Canada. I had 6 of my colleagues that I worked, they were all Bell telephone technicians, and I said, give me the money and let me invest. So I started with $51,000. And to me that was more than enough. I don't need $10 million to start with. Once you have $51,000 that I had, I just have to establish a record that I know how to manage money. So after 5 years, everyone can see my record. It's properly run, properly audited, and now the returns were coming. And then, then the doors open.
What is the best format to do that?
The format in Canada is most probably, an offering memorandum, like $150,000 or accredited investor. That is the lowest cost. If you go to the States, the legal fees will kill you. It's really expensive there, too many regulations. I have 2 funds in the United States and 5 funds in Canada. And I know, in terms of the legal requirement, it's 10 times more in States and 10 times more expensive. So start in Canada, and once you're ready, don't wait, just go. The time is of the essence. The younger you are, the more better off you will be.
The last question. Our last question. What is the biggest mistake that they're gonna make in investing?
Biggest mistake most probably, if you're going to make, I'm just generalizing it. One is overconfidence in certain sectors, overconfidence in your own ability without doing a checkup. Second one would be buying stocks when it has too much debt. When it has too much debt, buy the debt. and the third one is most probably when you think you're making a mistake, reevaluate. Like they say, when you're digging a hole, what you should do? First thing you should do is stop digging. So,